Justin, over the last 2 years, you sold off all but two of your single family rental properties. You have I know quite a few units of the multifamily, and I know that you want to move into more multifamily properties. We've seen mortgage rates rise up to upwards of 7.35%, and it seems like they're going to continue to go up. Real estate has been coming down quite substantially. Any chart, any person that you hear talking is talking about this massive real estate crash. The Fed is no longer in the market buying up those mortgage-backed securities or keeping interest rates artificially low. Real estate's taken a hit. All these over leveraged syndicators have been getting blown up. So when are you going to pull the trigger and start buying more multifamily? Because you were kind of way ahead of the game. I know over the last 2 years, you started to rotate all of your profits into gold and silver, where you then were waiting just to buy the dip on real estate when cap rates start to get more attractive. What are you seeing in the market now? And at what point will you pull the trigger on buying more multifamily?
Gotcha. The big thing we're looking for is I'm curious to see what's going to happen with rates. Right now, what you do not want to buy under any circumstance is when prices are high and rates are high. That's a recipe for disaster. The way it's been for the past, say, since 2012-ish, 2013-ish, for all intents and purposes, is prices started relatively mid-range. They got higher, but the important thing is rates stayed low. And now just what I'm seeing right now in the Texas market, maybe others, is that there's this standoff between sellers and buyers. That is, buyers cannot come up to meet where sellers are at, mainly because they can't make the debt work in their favor. Example, if you only have $2,000 a month to spend on your housing payment, and if the interest rate component of that payment goes up, that's less for principal. The less you can pay on principal, the less you can borrow initially. The less you can borrow initially, the less you can make an offer to the seller, even if you would want to offer more. You just are constrained by that. So you're seeing that come into the thing, but more to your point, Josh. What I'm very curious to see what's going to happen is that if rates go back down, that will catch my attention, because that means you can now use debt on favorable terms in order to pick up real estate. If you also see a deflation in the price of real estate, that would be very interesting as well. Now, with rates going down and a deflation, and asset prices going down in real estate, that's an interesting combination, because in that event, you would think that if people can borrow more, that would serve to inflate prices back up. Again, I don't know if that's going to happen or not, but if I see prices go down and rates go down, that's going to be a big thing, something that will catch my eye. The other thing that I'm curious to look at, it, I don't have a good metric for this, but this is just kind of show my thinking, is like the ounces of silver, the ounces of gold to your average median home. I want that to come back down. And in other words, I want fewer ounces of gold to buy property, which implies that the value of gold is strengthening against the price of property, or the price of property is falling against gold. And that would be another thing that would catch my interest. So to simplify that, rates going down would catch my interest. Deflation in asset prices, that is, property costing less, would catch my interest. And at the same time, the ratio of gold dropping to real estate, that is, you need fewer ounces of gold or whatever, right, to buy comparable real estate, that would catch my interest. If I saw those three things line up, I would be very interested.
I'm sure that you're looking at positive cash flow. What are the cap rates that you're seeing now? And that is basically just the total amount of cash on the property that you can receive, or the yield that you can receive. So what are we seeing now, and what do you think is appropriate rate to where you'd want to step back in?
We typically like to start off at least 10% and go a little bit above 10%. We were seeing cap rates falling as low on Class C property, and these were really beat up Cs, basically Ds, but nobody admits that a D exists. In the mid fives. That was insane. So in other words, it's like this. Imagine you go to a bank, and you basically have to pay how much am I going to get for putting $1 million into you for a CD or whatever, right? The higher the cap rate, the less the price of the property is the way to think about it. It's like bonds in a sense, right? There's this inverse relationship that's there. Now you can kind of juice it up a little bit by creative financing, but see, there's that debt component again coming back into the equation. But without the debt component coming back in, by constraining the creativity when it comes to financing, it becomes much harder to make deals work. This is what I've seen. I'll also note tangentially, I've seen a lot more properties marketed. And when I say properties, I mean multifamily properties marketed. So you do seem, my gut feeling is that you have people who were somewhat interested in selling, accelerating their plans to do so. Now, as to what discounts they're willing to take to move the property, that remains to be seen. But I do feel that it's, at least from the multifamily perspective on the Gulf Coast of Texas, it seems to be transitioning more from the traditional buyer's market, from the seller's market, which is what it's been for the past 8 years. longer, to sellers are seeming to have a little bit more leeway in the marketplace.
I mean,
Growth,
Justin, you were talking about inventory increase, and let's just take it back to May. There was virtually zero inventory coming up. Basically,
Yeah.
anything that was coming up was getting bid on. You heard every single real estate guy saying that there was 12, 13 bids, and people were overbidding just dramatically on these properties where it didn't even make sense. But what's happened basically since the Fed has started raising rates, the for sale inventory growth is up towards 67%. I mean, that doesn't seem like a pretty big number, but that's up from zero in May, and that is a very, very short time frame. So
Yeah.
what you're seeing in the market seems to be spot on.
Yeah, and the thing is days on the market too. You would also want to check this against days on the market. This might have it embedded in. I haven't had a chance to study the graph, but when you see days on the market creep up, and I would assume that's probably implied by inventory growing and being sustained. You're probably seeing that coming through as well. But anyways, Josh, to your point though, I think the bigger picture is that if banks are not constrained about making loans, like when a bank makes a loan, they
You also
obviously
need
are.
the demand, though. I mean, right now, I don't know if there's
Oh,
that
but
much
see,
real estate demand for
but see,
loans.
I think the demand's there, and what I'm seeing is that you see people that try to qualify, but they can't make. This is someone they're not trying to do an investment property. They're trying to buy like a home for themselves or whatever, right? Especially in the single family world, like you have normal, buyers, nothing fancy, who don't necessarily mind paying the price of what sellers were asking. They just can't pay the price. The reason they can't pay the price is because the underwriting for the loan can't give them a high enough loan amount to meet what the seller's asking for. And the sellers have not yet capitulated, or if they are, they're not capitulating in mass to move the market. Now, I think that's ultimately going to change, and I think it's going to change in favor of the buyers. That's my guess.
I mean, that's just human psychology, though. Sellers, especially in real estate, they're almost always looking in the past tense. They're saying, "Oh, last week these houses were selling for 500,000. You're asking me for 450. Go screw yourself, buddy. I'm gonna get 5,000 from the next guy." But what they don't realize is that prices are adjusting and they're coming down. Then when they say, "All right, fine. If you must, you can take it for 450." But now the offer is no longer 450. Now it's 400. And then they're saying, "There's no way. I was just gonna sell this for 500. I was stretching it to sell it for 450. There's no way I'm gonna sell it to you for 400."
And if there's that. Yeah. And here's the thing, right? Let's say they've got like a net for 300. Let's say they've got a net for 410,000. Like in order for them to sell it at 400, they're underwater. That's the other thing. So,
and so much leverage. In 2008, 2009, what everyone was doing is they were just buying single family rentals. That is the complete opposite from what we're seeing today. How many syndicators are there that are buying these humongous multifamily units? I mean, I know way too many people who are leveraged out of their eyeballs in these multifamily deals, because I mean, it was free money for the past 15 years, but we could be in an era where it might no longer be.
Yeah. Well, in any event, Josh, getting back to the things, what I would suggest is people who are looking at real estate, look at the following. Look for rates to go back down. Look for prices to go back down. And if you have parked value in terms of a commodity, so metals is the typical answer that I go to myself, but of course there are other options out there. Look for the ratio of, let's say, like, ounces of gold or ounces of silver to, your median home price, or Bitcoin, to your average home price. Look for that to be more favorable. In other words,
the reason why that matters is because if you look at a trend line of the ounces of gold to a house, it is very accurate over a long period of time. And the reason for that is, let's say 10 ounces of gold will always equal one house, because gold maintains the inflation level over time. So when you see those levels drastically change in either direction, there's something wonky going on in the market, and that's when there's a potential arbitrage opportunity. So Justin's saying he wants to buy when those come back to par.
Yeah, back down to normal. And the thing is that, like, as far as it comes from putting real estate money into commodities, it's not so much that you're trying to make a commodities play; it's that you're trying to retain your damn value. Is really what's going on. There's probably also an argument for cash, but there's, beyond the scope of this video, I've got concerns about cash and concerns about the banking system. But that's separate topic of conversation.
We'll let you guys know when Justin starts pulling the trigger on the next multifamily units. And if you would like to know exactly, join the premium subscription, Justin.
We don't have a damn premium